Welcome to the Accounting Play podcast, to know your numbers and to know your business. Welcome everybody. It's your host, John Gillingham, CPA from Accounting Play. It's tax season 2020 and we're answering write-offs, business expenses, ordinary necessary expenses, non-deductibles, and the home office. These are all questions I get a ton at my CPA practice. You can check out the downloads there. That'll get you some deductions, hopefully, with our gillinghamcpa.com/downloads. That is going to have the profit and loss template, some other goodies there for you. We're showcasing the app today, Tax Fight, formerly now called Write-Off. So let's get right into it. Generally speaking, you're going to have a business that's going to be making money, and you're going to want to keep that profit down because you're going to be paying tax on your profit, or at least your income tax. There might be other state, local taxes based on revenue or just simply being in existence. But most small businesses are looking to have profits, ownership, in which they can support themselves. And so the more legitimate deductions you have, the less tax you pay. So what might that be? Typical things can be supplies used in the business. When you actually sell a good, that's actually a cost of goods sold. Other things such as business use of telephone or outside services, very common. So paying people is an extremely important deduction for businesses, and that's how business works. And that's where you get into paying independent contractors, or if they're actually working from you, you're controlling what they do, where they do it, how they do it. They're probably more of an employee designation, and then you're paying them through a payroll service. That might be something like Gusto or Paychex. Highly don't recommend doing that yourself. We have our recommendations, Gillingham CPA/links. As far as that, you're also going to want to be tracking your deductions. That's where we recommend generally QuickBooks Online or something equivalent. So you really know where you are as far as your taxable income. And some businesses really get obsessed with deduction, and they spend too much of their money. Real businesses make money, have a profit, take their owner distributions or their owner's payroll, and they're going to have to pay tax on that. And they have to understand when growing, especially as an inventory-based business, that all that money that's sitting in the bank at some point in time, there's probably a lot of tax owed on that. And you can also kind of use your bank accounts to determine if there's 50 grand in there that you didn't borrow and you've earned it and you've paid all your expenses. Well, hey, that's probably some profit that you need to pay tax on now, or if you get an exception to pay it later. So the IRS started out as a pretty broad strokes as ordinary and necessary expenses. Then, of course, the courts and the laws change over time, and then things start to adapt. So not everything is deductible, even though it can be extraordinarily related to business, or even be deductible under financial statement purposes under generally accepted accounting principles and academic accounting. For example, penalties. Penalties and illegal acts are not deductible, but that's something that would still show up on maybe a financial statement that's audited, generally accepted, etc. So ordinary and necessary, some other resources. Of course, the download, profit and loss at gillinghamcpa.com/downloads, you're going to be able to see the laundry list of general expenses. And that comes into another topic, laundry. If I launder my own suit that I can wear on the street, that is not an ordinary and necessary allowable deduction. It's ordinary and necessary to the extent that, hey, look, I need this to go to work and look productive. Mind you, look productive. I try and wear shorts to work, but the IRS is not going to let you do that, especially if you come under audit. Of course, a lot of people, they put a bunch of garbage through their profit and loss to deduct it, such as street clothing, but that is in the non-deductible category, which we'll categorize more of that later. Laundry for linen service in a restaurant, for clothing only worn in that particular course of business, getting napkins laundered, things like that, that would be deductible. So there's actually court cases on these various things. There's a tax code, which is the kind of law, so to speak, that needs to be interpreted. Then there's further expansion upon that in regulations, and then there's court cases. And finally, the IRS tries to capture all of this in their general publications. And that is going to be publication 535. We'll have the links at countyplay.com/write-off and on the blog. So, or you can just search Pub 535. It's probably in excess of 100 pages with a bunch of what ifs and maybes. At the end of this day, I like to follow the flow of the cash going in and out of the business, as far as in and out of the accounts or use of the credit card, capture all of those things, and then decide as that goes through your typical QuickBooks Online or equivalent, you're tagging that as, is this a legitimate business expense, or is this something that I cannot deduct, in which case it's going to be something else, which we can cover that in more in-depth accounting. But you want to flag that. If you're keeping pretty loose books, just exclude it. You're just trying to capture the actual expenses. So this is very specific to what you're doing. If you're a consultant and a speaker, you're going to have different set of expenses than what's ordinary and necessary for running a circus. So understand they're industry specific. It's based on case law, but of course there's some general things like telephone or let's say office expense. Now, a lot of people starting out in business, they might have their telephone mixed up with other type of expenses. Now, let me pause here and say, of course, disclaimer, this is just kind of academic, very loose conversation for your entertainment purposes only. And if this is entertaining for you, we'll talk about that later. Just email me, john@accountingplay.com. So, what the heck can I deduct? Well, supplies as they are used, that's pretty clear. In the case of an early entrepreneur, the telephone might have a personal use percentage, and that person can determine, all right, maybe 75% of this is personal use, and the other 25% is business. That's okay, especially in the early days. The opposite is true, where you start flowing as much expense or as much flow of cash to the business as possible, and you realize, whoa, maybe that one trip was only 65% business, or there was so much personal stuff that that trip turned out to be 100% non-deductible. So you can allocate, and you can also completely deny your own expenses. Generally, you're going to want to be aggressive to the extent of the law, a little reading on the IRS website, some nice blog searches, and then finally talking to a professional who deals with this stuff. You can come to a great idea of what is and is not deductible. So let's talk about non-deductible expenses. Sometimes understanding what's not deducted is a good way of creating a line in the sand. So anything illegal, penalties, tax penalties, regular interest is deductible, but this is all in the course of business, just to reiterate that. But other non-deductibles is dry cleaning. So if you're a realtor and you're doing dry cleaning, no, do not deduct it. If you're in the business of being a CPA and doing the Accounting Play podcast, don't deduct your haircuts. Not like I got one recently anyhow. But if I did, we're not deducting that. So anything with a personal use to it typically has some restriction. Bribes are not deductible. Other things in the accounting world, such as purchasing inventory for resale, that is not a deduction simply because the inventory has not been sold yet. So that's actually just a transfer of money that is going out for an asset that's coming in. So costs that inventory, if you scrap it or you have, throw it away or sell it, that's when it becomes a cost of goods. So non-deductible expenses are also in the realm of entertainment, and this has changed. It used to be you could deduct 50% of entertainment. Now it's zero, at least for the current time being. So this is always changing. That's why a disclaimer is important. And to run it by a professional. Hopefully it's worthwhile. Otherwise you can, take some of more in-depth courses, at knowyournumbers, countyplay.com/KYN, or just, email me. We can have a talk or something. So non-deductibles continued. You don't deduct federal income tax. On state returns, typically state income tax is non-deductible on that state. So like California. Kind of get in the weeds there, but a lot of times the IRS, when they give an audit, a junior auditor, let's say you're a Schedule C, which is sole proprietor, you're filing your income and expenses on your own return, they're simply going to look at every single account. They're going to ask for some substantiation and receipts, and then they're going to say, why is this business? And then you are going to have to sort of substantiate that. So in your record keeping, you can make some notes, but certain things are simply non-deductible, like personal use luggage. Okay, no. But the gray area, if you're a photographer and this is luggage carrying your camera equipment, then maybe. So I like to give things the front page of Google or newspaper test. So imagine that everyone saw what you did. Don't be shady. Don't be a jerk. There's plenty of them in the world, but there's more good people. So be a good person. Deduct what's ordinary and necessary, what flows through your book, and definitely do not deduct the explicitly prohibited amounts. So that is the sort of polarized deductions, such as what's completely deductible and non-deductible. Meals is very complicated because we all got to eat, but it's not always deductible, and it's typically a 50% deduction. So meals in town, out and about, by yourself, I do not deduct those. I don't put my Starbucks or my Pete's Coffee, rather, or actually, hold on, Snowbird Coffee. You can see this video on YouTube, see the shirt that I'm wearing right now in the sunset, San Francisco. My Snowbird Coffee is not deductible. Now, if I'm buying beans for the office and everyone has access to those beans, then we might be looking at a 50% deduction. That used to be a 100% deduction. So all of this has to be in context. Now, if I'm whining and dining or drinking smoothies with one of my more healthy clients, then and I'm paying for it, we're talking business, that's probably going to be a 50% tax deduction. So there is complication in that gray area. What about if you're a restaurant? The food you sell, that's going to be cost of goods sold, right? So in that case, the meals kind of are deductible. If you're a chef and you're testing in the kitchen, that's probably a 100% deduction. But there's a lot of gray area. And that's where you do your research, you capture the flow of the expenses as one thing or the other, non-deductible, deductible, you kind of categorize, and then you can go through your advisor, figure out which category is going to be going on the tax return and what category is just capturing that flow of cash so you can have accurate books. Another thing worth mentioning, a little tip for my listeners, if you're starting a business and you have things that you've never deducted before, like a computer or like a reference library, maybe a big camera, talk to your professional and see if there's a way of getting those into your business so that you can deduct them over time using depreciation. Some other non-deductibles or limited are super duper fancy cars, right? If you buy a $200,000 Ferrari, you can't say, hey, this is going to only last 5 years, deducted over 5 years, boom, boom, nice car, not going to work. It's going to be limited. So there's a lot of limitations and gray areas. So by categorizing this stuff, you can go sort of line by line and work through, get a solid start with the professional. And that's going to just set you up for success. And ask that person, hey, have you seen this before? What happens in audit or otherwise? A lot of returns don't get audited. So it's not about what you can get away with. It's about capturing what's legitimately deductible. And tell you what, real businesses, real rich people outside of some sketchy ones, they make the money, they pay the tax, they save it, they reinvest. That's how it's kind of supposed to work. And it works for a lot of people, and at least a lot of American corporations. They have to pay their tax, and then what's left, then they get to use that for, dividends or expansion, et cetera, et cetera. Because not all expansion is fully deductible. If you build a building, that might be deducted over 39 years. It's not a one shot. So there's a nice primer. Let's go ahead and take a break so we can hear from our advertisers today. Brought to you by Write-Off, the app that teaches taxes and how to start a business, as well as structure, even accounting, with a game. Sorry if I deafened anyone there, but Write-Off is a really fun game. You get to pick your character like Johnny or Uncle Sam and get quizzed through these various topics. And I'm just looking here. You also get some feedback as you go along. You can go back into home, choose your 3 topics, and we got business deductions, business entities, general accounting, and more and more and more. So check that out on iOS. If you don't have an iPhone, we have a quiz at accountingplay.com and a lot of other resources there as well. Now, back to the podcast. All right, welcome back. So earlier in the podcast, we were going over ordinary and necessary expenses, non-deductible expenses, and the gray area in between of sort of 50% deductions. Now, and go to that Pub 535, see what the IRS has to say about it, really talk to a pro and get that structured for you in the context of your unique business. Now let's talk about a famously common question about the home office. Now, the IRS also has, get this, a 35-page publication to try and help you out with this. And I can discuss some of the realities of my experience with the home office, kind of how it works. It used to have about like a 5 or 6 part explanation. Now it sounds like they're going a little bit towards 1 and 2. Number 1, regular and exclusive use. And number 2, critical, principal place of business. Now, this is all for self-employed people, really geared towards the Schedule C. That's the sole proprietor and reporting this information on your own tax return. Let's discuss the general mechanics of an ideal situation. Someone may be renting a 3-bedroom house, and one room is exclusively used for their consulting business. They might be writing online. They'll occasionally do a speaking event here or there. They'll deduct the transportation away from their home office back into their office at home, and then they will basically do most of their work from the office. They don't allow guests to stay in there, and they rarely, if ever, have any fun in this home office. So, number 1, it's regular and exclusive use. Great. Number 2, it's the principal place of business. Let's discuss now how this might get outlined as far as bringing those expenses to your tax return. This is for a rented house for simplicity. Say the house is 1,000 square foot, and then the home office is 10 foot by 10, so we're talking 100. There's basically a ratio that's then formed, 10 divided by 100. You have a 10% use. Now, all the quote-unquote indirect expenses, such as the total rent, will get reported on what has traditionally been the Form 8829, business use of home. That form might be shifted around. Now, if someone says, let's say they're spending $12,000 a year on their rented home in Texas or Alaska or Mexico, somewhere in America, maybe Mexico, there must be one, city, county, somewhere. We're talking the US here. Anyway, so call 10%, Paris, Missouri, let's call it. You're in Paris, Missouri, you're a consultant, you're in taxidermy, you're a hunter, etc. Not that I'm into that, but I'm from a place where they. Anyway, 10% multiplied by the, this case, 12,000. That's going to get you your $1,200. So you have a $1,200 rent deduction that goes into the form. You might also take total expenses on things like utilities. You might have total expenses on things like the home alarm system, right? So you're looking at maybe even the garbage expense, these total indirect expenses, and then you're taking the 10% ratio that is flowing into the tax return at that point. And so it's a ratio. When you get into having a mortgage and ownership of the property, it gets quite a bit more complicated because the IRS is going to want to have you depreciating, whether you want to or not, a part of the home, which means essentially the value of the home is going to get divided out over the years. Typically, home office will be maybe commercial, maybe 39 and a half years. Maybe this would be different by the time you listen to this, or there's some nuance to these rules. Now, the interest portion of the mortgage, the property tax, and these sorts of things are now flowing through. And so that's getting a bit more complicated. If you're running two businesses out of that office, it can further complicate and sort of make life a little bit more of a thinking process. Now, it even gets weirder if maybe you rent it half the year to someone else and this kind of a scenario. But those are the very basics. You're just taking a part of your home and you're using it. This thing is cluttered full of your tools and your business toys, and you're not playing with them. You're using them for work. No fun allowed, maybe occasionally. So you're just right in that sweet spot. Pretty simple, regular exclusive use, principal place of your business. Things are going to get a little bit more complicated when you're further outside of that. But going right back into our fairy tale home office, which definitely does exist, it's great because every time you're leaving that, you're stepping outside of your home office. It makes it much easier to deduct your business related travel because essentially your commute is nothing. And there's a lot of complication that goes to commute that you can discuss with your tax advisor. But if you can have these two factors really locked down, it's wonderful. You can take measurements, pictures, and more people are working from home. This used to be an audit area from my understanding, simply because people used to have to go into physical offices so much. It was really rare that someone had a true home office. It was an easy opportunity for an unknowing taxpayer working with the wrong tax preparer to get a bunch of deductions whenever they can. But now it's a little bit more normal. A lot of major small businesses, if that's not an oxymoron, are going to have home offices. I'm always really surprised. So that's in a sole proprietorship situation. When there's a corporate entity involved, it gets quite a bit more gray area or complicated or even disallowed, because it's going to be rare or possibly prohibited for a big C corporation to simply pay for someone's home office. There's going to be a lot of rules and regulations in place that you're going to have to establish with your tax advisors. So I think it's a tremendous opportunity and something to explore. Don't be spending money just to waste it, right? If you need an expensive ergonomic business desk and it's pretty ordinary, it's less than $1,000, exclusive use, it's going into the home office, great, do it. If you need to repaint it, that specific area, and decorate it, that are probably specific to that home office. So long as it's not significantly improving the value, in which case it's probably a business capital improvement, maybe deducted further along over time. So you see how something supposed to be kind of simple starts to get more and more complicated. Now, speaking of simple, there is a simplified business method where the IRS allows a tiny deduction based upon square footage, and that's it. I believe a lot of the carryovers and benefits like that are not there. Important to note also with the regular method, typically that is not going to draw your business to a loss and allow you to offset your other income. It would probably carry over in the future. So it can be very, very valuable, very, very tricky. Definitely document it and go for it, as long as you have the green light of your professional, and really take use of the advantage of working from home. What you cannot do is take your dining room table and call that use your home office if you're eating there all the time outside of the line of work, slurping noodles at your desk, etc. Your family's running around, you're constantly using it for other purposes, then that's probably not going to qualify. Don't let a small or modest home size deter you from the home office if you can meet the qualifications. So there's been some interesting case law in that area, because not everyone lives in Texas. Some people live in San Francisco and New York City, where space is very expensive and very small. Definitely document with that. Who knows? Maybe even over time, like a couple photos here and there. As the year goes on, if that's going to be a really significant deduction for you, and you're essentially taking half a studio apartment perhaps and turning it into a film studio or your writer's den, and you're having your significant other over there, and they're like, honey, can't we use that area? And you're like, no, that's my exclusive use area. So it's kind of like ruining the space of the home. So if you're ruining your home with the home office, then and it's a tiny space, you better be getting the value for it. So there's a lot of nuance in there. Definitely work that out. So business deductions are fun. In conclusion, it's fun to deduct. Follow the flow of cash. Don't be sketchy. Get this cleared by a non-sketchy tax advisor person, and understand sort of the laws. I gave you some great publications and resources, including the IRS 35-page guide, time of recording, on the home office. So there's lots of resources. Just because you put it on your tax return doesn't mean it's right. And definitely don't just buy a bunch of business-related stuff just to get deductions that aren't really going to do much. So, for example, in the past, I've sometimes purchased some expensive software that I shouldn't have purchased, internet that's way too fast for my needs, anything to try and grow business, via getting more deductions or expensive advertising campaigns, AdWords. These can be real traps. So if you're not seeing very real results from your expenses, and you can take out your own trash or vacuum your own floor, then I highly recommend you do it. A lot of truly successful small businesses do a ton for themselves. They avoid expensive software. They're extremely careful every time they spend. It's painful for them, not fun. So even if it involves just having a debit card instead of a credit card, people are addicted to points. I think it's fun to spend for business. Some people don't. And when they don't, and they're those people that they don't want to pay for online storage, they're so cheap. And I'm like, oh my gosh, you made $1 million last year. Well, there's a reason for it. So take that all to account. Please check out the downloads, GillinghamCPA.com/downloads. Free stuff on accountingplay.com. Lots of old podcasts that are more academic. And please download right off. We worked really hard on it. I think you're going to love it. And give us feedback, john@accountingplay.com. This is all educational, very broad, but hopefully get you thinking in terms of deductions, and even better, the app. Right off. Bye.
You have been listening to Accounting Play and Know Your Numbers. Check us out at accountingplay.com, and if you need a CPA, check us out at gillinghamcpa.com. Until next time.